Right now, everyone is talking about the AI bubble, Bitcoin's next all-time high, or hyper-analyzing Jerome Powell's press conferences like it's a new GTA 6 trailer. The financial media sells you Nvidia's earnings or the latest political tweet as life-changing news. But the biggest risk to the economy isn't the loud stuff. It's something much more boring, something you've likely never heard of because it doesn't get clicks. The real danger is hidden in the deepest, most technical corners of finance that nobody wants to talk about: shadow banking. Today, we're going to look at how this system has quietly become the bottom block in a very tall, very unstable game of Jenga, and why financial gravity is about to kick in.
If traditional banking is a boring government office where every move is regulated and watched, shadow banking is like a back-alley casino. It sounds flashy, but there's a problem. Nobody actually knows how much debt is on which table. Shadow banking is just a formal way of describing institutions that act like banks but aren't technically banks: hedge funds, private equity firms, and money market funds. They don't take deposits, so they don't have to deal with the boring regulations that traditional banks do, but they provide the oxygen of the markets: liquidity. They lend money and move capital, but they do it in the shadows. There's a popular narrative in finance. The system is safer now than it was in 2008. But when you stop looking at the story and start looking at the data, you see a very different pattern. Risk wasn't destroyed after 2008, it was just repositioned. When regulators put a leash on traditional banks, the risky trades didn't disappear, they just moved to these shadow areas where nobody's looking. This is the same narrative dependency we see in crypto. Just as Bitcoin's story shifts from digital cash to inflation hedge every time the tech fails, the safe system narrative fails to mention that shadow banks now hold trillions in leveraged bets without any central bank safety net. If things go wrong, the oxygen mask drops for them first. To understand how fragile this is, we have to look at what I call the Japanese Wi-Fi. For decades, the global financial system was held together by the yen carry trade. Investors borrowed money in yen at 0% interest to fund risky bets in the shadow banking world. It was free money. But in 2024, that assumption broke. When Japan raised rates, the math flipped. Suddenly, the free money wasn't free anymore. As the yen carry trade unwinds, the shadow banks that relied on this cheap liquidity are finding themselves at the bottom of an unstable Jenga tower. When the bottom block moves, the whole tower shakes. In the shadow banking world, we often see the greater fool theory in action. This theory says the price of an asset doesn't need to be justified by its value, as long as there's a greater fool willing to buy it from you higher later. Shadow banks often buy up debt, not because the underlying assets are productive, but because they assume liquidity will always be there to bail them out. But as we've seen with prop trading and crypto, the moment new buyers or new liquidity stop entering the market, the entire machine breaks. Markets can stay irrational for a long time. They can ignore earnings, cash flows, and boring economic data in favor of hype and momentum. But eventually, fundamentals show up like gravity. Whether it's an oil crisis in the Strait of Hormuz or a shift in Japanese government bonds, these catalysts eventually force the market to face reality. Shadow banking has been defying financial gravity for a long time, fueled by cheap debt and lack of oversight. But when liquidity tightens, the cost of money changes everywhere, from your mortgage rate to the valuation of tech stocks. Prop trading get-rich-quick dreams are fake, and the idea that the financial system is 100% under control is just as misleading. Shadow banking is the hidden in plain sight threat that the traditional media ignores because it's not clickable. In the end, it doesn't matter if it's crypto, Japanese bonds, or shadow loans. When the narrative loses its grip on the data, gravity wins. The real threats aren't the loud ones. They're the ones hiding in the shadows while everyone else is looking at Nvidia's stock chart. So, what's the main takeaway? Shadow banking isn't just a niche topic. It's the duct tape and the bottom Jenga block of our entire system. While the traditional media is busy selling you narratives that get clicks, the real risks are hiding in plain sight. Because in the end, it doesn't matter how long a bubble lasts. Eventually, fundamentals show up like gravity. I made this channel because I want to shine a light on the issues that actually matter, even if they are boring. If you're tired of the noise and want to understand the real math behind the markets, hit subscribe and turn notifications on. Thanks for watching, and remember, the loudest stories are rarely the truest. Stay safe. See you next one.